Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. Let's get you up to speed on the market action. We are seeing the losses accelerate with just an hour left to go in the trading day, with the Dow now down more than 300 points, right near the session lows here. The S&P 500 down 58 and the Nasdaq down 285. The big driver today, of course, Fitch downgrading the long-term rating for the U.S. That has sparked the declines that we are seeing there. In terms of sectors we're watching right now, consumer staples and utilities really the only ones kind of bucking the trend. We are seeing a broad-based sell-off as we see investors go risk off right now, Shauna.
Yeah, Kiko, and let's dig a little bit deeper here into this sell-off. You mentioned the major averages, the losses that we're seeing there. The Dow right around the lows of the session. The S&P trending back towards that 4,500 level, a key level to watch here. And the Nasdaq on track, flirting with its worst day that we've seen since February. So some losses here, especially among those more riskier assets. That's what's leading today's decline. And this sell-off really sparked by what we're also seeing play out within the bond market, as I lose the touchscreen here just a little bit. But we are seeing the yield on the 10-year push higher here. Obviously, that is something to note when you take a look at the 10-year yield, up just about 3 basis points, well above that 4% level. The 30-year yield moving to the upside as well. Let's dig a little bit deeper into the sector action. You were just mentioning we're only looking at 3 sectors right now that are just barely in positive territory. Among the biggest decliners, technology, the XLK, that sector off just over 2%. Communication and consumer discretionary also among the biggest decliners there. And taking a look at the tech sell-off within the Nasdaq 100, and as you can see, there is a ton of red on the screen, and we are seeing selling pressure from everyone, from the larger cap tech names that have really led the rally since the start of the year. You're looking at Apple, Microsoft, Google, Amazon, all of those names off just about 2% or more. And then even the smaller, more riskier plays, we're also seeing some losses there. Taking a look at the semis, the chip plays here, some intense selling. AMD among the worst performers there. We're looking at losses of nearly 6%, so really leading to the downside. Actually, all 30 of the chip stocks in the Philly Semiconductor Index are trading in the red here as we enter the final hour of trading. Taking a look inside the Dow, it's not just tech, it's not just semis, but when you take a look at some of the pressure that we're also seeing from some of the banks, you have a name like JP Morgan, that stock off just over 1% today. And digging a little bit deeper into those bank names, we really are seeing red across the screen when you're looking at JP Morgan, Wells Fargo, Bank of America, all those names off just about over 1%, as well as Morgan Stanley and Goldman. So Akiko, certainly a lot of fear entering the market today, and investors trying to figure out what this downgrade from Fitch, what it means for equities moving forward.
Yeah, pretty much right across the board there. And to Shauna's point, let's talk about what is driving these losses. Our top story of the day: Fitch downgrading its AAA credit rating on the U.S. The agency blaming rising political divisions and mounting debt. Treasury Secretary Janet Yellen denouncing the move, calling it, in her words, entirely unwarranted. Our next guest says Fitch made the right move. Joining us now is American Action Forum President and former CBO Director Douglas Holtz-Aiken. It's great to talk to you today. Help me understand why you think this is warranted. I'm also curious to hear about what you make of the timing of all this, coming just months after the U.S. narrowly avoided a debt default.
Well, on the substance, Fitch said 3 things. Most of the conversation has been about the erosion of governance, but they also pointed out importantly that the U.S. has a seriously unsustainable fiscal outlook, high deficits and debts that will get higher relative to GDP as far as the eye can see. And importantly, it has no plan to deal with its fiscal outlook. And so on the substance, the U.S. has a very big problem. And this isn't news. This has been true for a while. And the fact that we continue to not deal with it, I think, is at the heart of the downgrade. The more controversial piece is this notion that there's an erosion of the capacity for governance and financial management, and that this is, as a result, why Fitch moved now. And there are a lot of talk about timing, but I think timing has very little to do with this. We've had a problem for a long time. We haven't dealt with it. That's what needs to be dealt with, not what's going on right now. If you look at the debt ceiling, the fight, the latest political skirmish that, lots of finger pointing about that, it's actually, I think, a really good example of the problem. That got us a suspension of the debt ceiling until January of 2025. Great. That's the only good news out of that deal. Substantively, it did nothing to deal with the budget outlook because it didn't touch taxes, it didn't touch the entitlement programs, and those are the problems. It touched discretionary spending. That's not the problem in the federal budget. And those caps are unlikely to hold. Congress has never adhered to its own caps. Governance-wise, that entire episode is being relitigated right now in the annual appropriations process. The House and Senate are $100 billion apart, are unlikely to come to agreement. So it didn't solve any financial management or governance issues. So I think Fitch is reading the evidence pretty straightforwardly.
So it's about how long this has been going on. I mean, you look at Fitch's own modeling, it shows concerns with U.S. governance dating all the way back to 2018, right? I mean, that's 5 years ago. It showed recovery that was happening over the last year, or at least under this administration. I mean, sure, maybe timing doesn't necessarily matter, but why years later after they saw this?
I think it's a very strange argument, which was made today by the CEA chairman, Jared Bernstein, that, well, we should have had a downgrade under Trump, right? That's what we should have had, and not now. Well, why is that a good defense of what this administration has done? I mean, it has done nothing to deal with the fundamental problem. It has said openly, the President of the United States in the State of the Union, we shouldn't touch Social Security and Medicare. It is impossible to rectify the U.S. fiscal situation without putting them on sustainable paths. So they're actually part of the governance problem. They're pointing in the wrong direction. So I think this is a shoot the messenger operation, but the messenger is not the problem. The problem is the problem, and it needs to be dealt with, and it's not being dealt with.
So, Doug, there's a responsibility, right? And I think you agree with this, just on both sides of the aisle, that these issues, these fiscal issues, need to be dealt with. Do you think this downgrade from Fitch, is this really going to move the needle at all? Is this going to push both sides to be able to come to a better longer-term or a longer-term solution?
I'd like to think so. I'm not convinced of that. It's one of three rating agencies. If we got S&P and Moody's to join hands and downgrade as well, that would get a lot of attention. That would move credit spreads. That would affect markets dramatically, and that might spur more action. But I don't see that happening from just Fitch moving by itself.
You know, we're looking at the market reaction today, a sellout that's not happening, but you could argue that there has been a little complacency kicking in, even among investors, about what this downgrade really means, right? When you consider what happened the last time. And I wonder, when you think about how much debt there is right now, and you look at the higher rate environment, to what extent is that risk accelerated now?
Certainly, the federal budget is now a highly levered, interest rate exposed entity. Over the next 10 years, the U.S. is going to spend about $80 trillion. $10 trillion of that is going to be interest on previous borrowing. And so, when you're getting up to an eighth of the budget, over 12%, that's a real exposure. And that should be cause for concern by rating agencies and everybody. So I hope that this rate environment and the exposure of the budget to interest rate swings will really spur some action to get things under control.
Doug, we heard from Mohamed El-Arian. He was on Yahoo Finance Live earlier today. He was skeptical of Fitch's change. Let's play a quick soundbite from what he had to say.
So the only response I would have to this is why now? What Fitch put in their statement has been true for a while. So why now? And that explains the reaction that I and many others have had, which is, first, this is surprising. Second, when you look at the reason, you scratch your head as to the timing of this. And then thirdly, which is most important for our audience, is the expectation that this will have minimal impact on the things that are sensitive to ratings.
So, Doug, we can debate the timing all we want, but we are seeing some concern, at least right now, within the equity markets. But from your perspective, the economic implications of this, why this issue needs to be addressed, the risks that are associated with this, what's on top of mind for you?
This is not something that is a feature of the landscape over the next 6 quarters, say. Fitch had in its press release a call for a recession. That's pretty irrelevant. This is about the basic mismatch over the long term of spending and revenues. And remember that every time you take a dollar from private investments, put it into a government investment, the best government investment, you lose half the rate of return. And most of the federal budget is not about investment. Indeed, we're increasingly squeezing that out and doing just transfer programs and consumption. So the federal budget is the greatest headwind to productivity growth, innovation, and raising the standard of living, the single biggest threat. So that's a self-inflicted wound that we should just stop, put it on a more sustainable trajectory, and allow people to make more money over the long term and move ahead. The standard of living doubles about every 70 years now. It used to be every 35. So it's harder and harder to reach the American dream, and the federal budget is at the heart of those problems.
So, Doug, let's talk a bit more about that path ahead. I mean, you look at where both parties are. It seems very polarized environment in D.C. What are some of the cuts that they can agree to? I mean, how do you reduce this number if at the end of the day, spending is just way, has gone out of control?
So the things that they are fighting about are the least important things in the federal budget. The annual spending on defense and non-defense discretionary. What matters is Social Security. Social Security is the trust fund will bankrupt in 10 years. That means a 55-year-old does not have any idea what he or she will get in retirement. That's a huge disservice. That's no way to run a pension program. On behalf of the beneficiaries, do a Social Security reform that puts it on a sustainable path so that individuals can plan and the budget's not bleeding red ink. Medicare is responsible for 1/3 of all federal debt outstanding. It is not designed to be financially self-sufficient. It needs to be put on a sustainable path. It's a core part of our social safety net. So the discussion should be about what will be the scale and growth of these large pieces of our social safety net. And it's not. It's about a red herring, this piece, which is the annual spending. And we have to have a real conversation about the tax code. The 2017 tax reform is going to sunset in 2025 in its entirety. Is that something we want? Don't want? What's it going to take to be able to afford to keep rates at this level or have them go up for everyone? Those are conversations that we have, not the ones we're having.
You think we can have that meaningful conversation a year out from a presidential election? No,
I don't. I think the most, to me, the most telling thing about this is the average American has no idea there's a problem. This has gone on for the entire 21st century. Under Presidents Bush, Obama, Trump, and now Biden, no one has said to the American people, we have a big problem and we need to deal with it. They have said other things. President Biden has continually proposed new programs that would massively expand the problem and without any cause or concern. President Trump said nothing. President Obama said, well, there's really nothing wrong with the federal budget as long as the rich pay their fair share. And President Bush said, well, the budget is about winning the global war on terror. So no one who holds the highest office in this land has put on the radar screen to the American public that they need to think hard about our fiscal future. And that, I think, is the fundamental problem.
Well, it's great to get your perspective today. Doug Holt-Aiken, American Action Forum President and former CBO Director. Thanks so much for joining us today.
The Federal Reserve Bank of Kansas City finally has a new leader. Yahoo Finance's Jennifer Schomburger has the details for us. Jen.
Hey, Shauna, that's right. Finally, the Kansas City Federal Reserve announcing a brand new president after more than a year of searching. Jeffrey Schmidt will take the helm starting August 21st. Schmidt brings 40 years of banking and regulatory experience to the post. He started his career as an FDIC bank examiner where he oversaw troubled lenders. He served as CEO for two small banks, the Mutual of Omaha Bank in Omaha, Nebraska, which was started by the insurance company with the same name, as well as Susser Bank in Dallas, Texas. Now, Schmidt was most recently president and CEO of the Southwestern Graduate School of Banking Foundation at Southern Methodist University's Cox School of Business. Schmidt succeeds Esther George, who retired from the bank in January after turning 65, as required by Fed rules. And he will take the helm just days before the Kansas City Fed puts on the Fed's famous annual economic symposium in Jackson Hole, Wyoming. Schmidt coming to the Fed towards the end of the central bank's most aggressive interest rate hiking cycle since the 1980s. Fed officials decided to raise rates for the 11th time since last March, and what may be the first of the two last rate hikes in this cycle. Shauna.
All right, Jennifer Schomburger, thanks so much for that. Well, we are just getting started here on Yahoo Finance Live. Coming up, the bulls have been in charge up until now, with Oppenheimer's John Stoltzfus chief among them. His year-end target on the S&P, the highest on the street. But what about the Fitch downgrade? We're going to ask him next. And backtracking, economic strength continues to defy expectations as Bank of America economists follow the Fed and reverse their call for recession in the U.S. Are we being too optimistic? We're going to delve into that. Plus, global smartphone demand has been weak, and that's not good news for Qualcomm. But does the stock's relatively low valuation make it an attractive proposition regardless? We'll bring those results to you as soon as they break. We'll be right back.
Welcome back to Yahoo Finance Live. Let's do a quick check of the market sponsored by Tasty Trade, a broad-based sell-off that we're seeing right now with about 45 minutes left to go in the trading day. The Dow now down roughly 360 points and the S&P 500 down 66, with the tech names taking some of the biggest hits, with the Nasdaq down more than 300 points. Also taking a look at the VIX, we have seen it quite elevated there as we see investors turn risk off, up about 15% right now.
The calls for one of the most talked about recessions in history are starting to recede. Bank of America now sees the Fed's interest rate hike ending in a, quote, soft landing. Yahoo Finance's Josh Schaefer has the story for us. Josh, a recession, not so much a sure thing at this point in terms of the forecast.
Yeah, Shauna, so we're starting to see some people reeling back those recession calls that we've talked a lot about. It was going to happen in 2023, then late 2023, then Bank of America had actually been projecting this to happen in 2024. And now they're out today saying, you know what, that recession might just not happen at all. So I want to walk through a couple of charts here that sort of make the case that Bank of America is making for why we won't see a recession. So right now, what you're looking at is just B of A's projections for GDP growth. U.S. economist at Bank of America, Michael Gappin, noted that when you look at the GDP chart itself, it's been over 2% for about 4 quarters now. Atlanta Fed out yesterday projecting that we're going to see 3.9% growth. So pretty big expansion realistically from what we've been seeing in this quarter. Now, again, that's a projection well out into the future for Q3, but interesting to take a look at that. And then you take a look at another chart. He points to just simply the unemployment rate, right? The unemployment rate's been relatively flat. It's been hanging around that 3.6% number, meaning the labor market continues to be tight. So you're not going to necessarily see a recession when you have this tight of a labor market. But you do have some wins for the Fed piling up when you take a look at wages. Wages are starting to come down. And that is a key part of the discussion when we talk about inflation. So you take a look there, you can see wages falling. And that is a key point for maybe being able to also see inflation start to fall as well. So when you take a look at the inflation number and what we're looking at with headline PCE, you can see B of A actually now thinking that inflation is going to fall at a slower pace than they initially thought, which is interesting when you think about no recession. But they're more in line with what the Fed's forecast is now, seeing us getting to that target 2% rate by about 2025.
Yeah, certainly very in line with what we've heard from Powell in the past. Josh, I have a feeling that we're going to see this trend kind of play out in the street, right? People have been so committed to their recession calls now for the majority of the year, waiting for it to happen. Do you think this is the first step just in terms of the economists fading and kind of being a little bit more realistic about the picture?
Someone's going to step up and do it first, right? And this is really of the economists we track, Bank of America is the first team to come out and really do this and say, you know what, we're not going to see that recession. A lot of them, if you read through these notes, these long economic notes, somewhere in there they've been hinting, you know, we might not see a recession, or the chances of a recession are a little bit less. So this is the first group to really come out and say it, but it's the same thing when you think about just how these projections work. Go back to June and everyone's projection on the S&P 500, right? One person bumps their price target, then next thing you know, within 2 weeks, 5 strategists have bumped their price target on the S&P 500. So I do think now it makes people a little bit more comfortable to say maybe that recession isn't going to happen. And to be honest, it comes in check with what Powell is saying too, right? That has been their base case for a long time, that they think they're going to see a soft landing. And now it seems like people are actually just starting to listen to him and seeing that play out a little bit. So maybe we'll see a pushback, or maybe we'll just start talking about the 2025 recession.
Exactly. I hope not, but we'll see. All right, Josh, thanks so much. Well, stocks sliding in today's trading session after Fitch downgrades the U.S. government's credit rating. So what does this mean for investors? Joining us now, I want to bring in John Stolfus. He's Oppenheimer Asset Management Chief Investment Strategist. John, it's great to see you. So ahead of this downgrade, you raised your year-end target for the S&P to 4,900 from 4,400. This downgrade from Fitch, does this change your view at all?
Not at all, Shauna. And in fact, you know, and I know we've had a large flow of information from economists from around the street throughout the day. When we think back of the downgrade, I guess it was Moody's in 2009, there was a lot of drama initially around it until it's just realized that people don't buy the U.S. Treasury because it's AAA rated. There generally aren't mandates among managers that they have to buy AAA rated government paper. And already, you know, as a result of the earlier downgrade, it wasn't all AAA rated because Moody's didn't have it. So, the market's a lot higher than where it was in 2009. My recollection is at one point in 2009, the S&P 500 was at 676, and it took years to get back to 1535, as I recall, which was the October 12th, 2007 peak of the S&P 500. So it's not an issue. We really think the main thing is we got to see the economy keep growing in here at a modest pace. Jobs to remain, resilient, the consumer resilient, business able to navigate the current scene. And essentially, the Fed being very sensitive about the way it's raising rates over 11 times, bringing down the headline number down by about 2/3. Now, with a little bit of trouble on the core, where it's still, what it was, the headline is 3%, it dropped 3%. And then you got, was at a level of 3% up, and the core was up, 4.8 or something like that. Mm-hmm. So that's, a distance away from the 2%, but we're progressing nicely, and stocks are reflecting that.
So we saw private sector companies adding far more jobs than expected in July. The ADP employment report pointing to strength in the labor market. What does this mean going into Friday's jobs report?
Well, when we think about Friday's jobs report, based on what we've seen over the course of the last few months, it's fairly steady. It looks to us like you're going to see a fairly strong number. The consensus number is likely to carry in this situation at around 200K. You're going to get a slight uptick on the wages, but overall the level of inflation's growth has been coming down, and you've got the economies moving at a slower pace. The increases in the inflationary aspect is softening, and it looks like we may very well be able to skirt a recession. We've said that, by the way. If you go back to our pieces that we wrote last December, when we put in our 4,400 target, which at that time was, I think, second highest on the street. Now we're at 4,900. Last I looked, I think we're the highest on the street for the end of this year. We were looking for the likely a bumpy landing at worst, and maybe the possibility of skirting a recession. And we've believed the Fed. We're big students of the Fed. I got into this business in 1983, so I've had to work under the effects of Volcker, the effects of Greenspan, Alan Greenspan, and then Bernanke, Yellen, and now Jerome Powell. And the Fed is much better than it ever has been at communicating since Bernanke. This is the Bernanke legacy under Powell.
But John, can't you make the argument that the market is hearing what it wants to hear from Powell? Because Fed Chair Jay Powell, he did say that they are leaving the door open for another rate hike. Yet when you take a look at the Fed fund futures, less than 20% of traders see a hike at the September meeting, and not much more see a hike at the meeting after that. So are they reading it right, or are they still being a little bit too optimistic?
Well, I think traders will be traders, and the Fed will be the Fed. I think the Fed is being straightforward, and the traders are placing a bet on it. But we've seen before, going into the most recent hike here in July, my recollection is leading up to that, there was a lot of opportunity to see, there was a chance, I think, that they wouldn't see a hike. And of course, the vast majority of them expected a hike. It came in where it was expected. I don't think it's much of a concern here unless the Fed would do something drastic in terms of an uptick in cuts, uptick in hikes, or if it were to cut, I think the market might be absolutely stunned. And I don't think that's going to happen. I think, they may skip September. I think there's a real possibility of that based on what we're seeing right now.
So let's talk about how investors should be positioning themselves. In the expectation, it sounds like that the Fed will likely skip come September. Where do you see value right now?
Well, we continue to see value in industrials. We've liked the industrial sector now for years. It's well positioned in the area of power generation, whether it's alternative or whether it's traditional things for fossil fuel that carries the bridge into the alternative era. And then in addition to that, it's aerospace, it's defense, it's robotics, it's all kinds of sensors and things that make industrial equipment more efficient. In a period where we've got this huge infrastructure bill, we're going to hopefully see the money start actually be meeting the road, and actually moving things in terms of building the infrastructure. And then you got the CHIPS Act, and we think the industrial sector is very well placed. We also continue to like profitable technology that's deeply embedded in the lives of both business and consumers. And we continue to like the consumer discretionary, because the American consumer is a very tough consumer to bet against. Because when times are flush, they spend like sailors who have just been got off a long tour of duty. They'll spend money pretty wildly, but when times get tough, they become much more discerning about what they spend, where they spend it, but they keep spending because the American public, as a consumer, vindicates or validates their existence in many ways just by the fact that they can still buy something.
All right, we will see whether or not the consumer holds up if we do see any sort of pullback here. John Stolfus, great to have you sticking by 4,900 target on the S&P by year end. Well, coming up, it's been a rough few years for Teva, the world's biggest generic drug maker, balancing a battle to cut debt with some expensive legal challenges. But shares are popping today. We will speak with the CEO next.
Well, shares of Teva Pharmaceuticals soaring on earnings. The stock is up more than 10% today. The company reporting better than expected results with revenue up 2% from a year ago. The results driven by sales of its Huntington's disease drug Austedo. Joining us now is Teva Pharmaceuticals CEO Richard Francis. It is great to talk to you today. Certainly investors liking what they heard today. Austedo is one of a trio of drugs that the company has essentially bet its future on. And you yourself have said, look, this is a setup year. The real gains will come next year. So when you think about the potential, how big of a revenue driver do you expect these branded drugs to be?
So thank you for the question, and thank you for having me on. So I think the potential is significant. When we launched our strategy in May, we actually said, we called it the pivot to growth strategy. And we actually think Austedo, one of the drugs you mentioned, can do $2.5 billion in revenue by 2027. The two others that we talked about were Jovi for migraine and Uzedy for schizophrenia. And those, coupled with another launch we have coming along for an olanzapine, another product for schizophrenia, we really think that that can create a significant innovative business for Teva that has significant growth. So I think that's what we're talking about. But as you've highlighted, we've got to show we can do that. And I think Q2 showed that we have the potential to drive our innovative business. We just got to make sure we keep doing that.
Richard, when it comes to the product pipeline, obviously very exciting goals that you have in mind. In terms of your ability to reach those, I know you've struggled with labor shortages in the past, the shortage with Adderall here in the U.S. being a huge issue, with Teva being the largest supplier of Adderall. What does that landscape look like today? Have you seen improvement, significant improvement, when it comes to the labor side of your business?
We have actually. In fact, when you look at what we're trying to do here at Teva, with our pivot to growth strategy, we're having to actually recruit people in all different areas of our business. As we expand our innovative business, we've hired people from that innovative sector. So R&D, we've been expanding significantly, as well as in our clinical development, because we have a pipeline, as you highlighted there. We have 3 assets in our pipeline that are very exciting: olanzapine for schizophrenia, a product for asthma, and then a TL1A, which is been the talk the last few months because of some acquisitions, one made by Merck of Prometheus, and then another company that's been talked about, Reavan. So I think we have we've really enhanced our staffing in those areas. And then on the commercial side, we've expanded our sales force for Austedo and Uzedy. So we actually are hiring, and we're finding it, competitive still. But I think Teva is has a good value proposition because of our story and our trajectory and where we're trying to take the company.
As we highlighted at the top here, this is a company that is really in recovery here. You have been hit with one legal case after another. Today, you talked about setting aside $200 million for a possible settlement with the DOJ around price fixing. There's also those cases around the opioid settlement. What does that path look like coming out of that litigation? And where does the recovery go from here?
Well, look, I think you summed up really well there. As we are coming out of that litigation. So I think that litigation is behind us. And what we're now doing is focusing on growth. And what we need to do is make sure the resources of the company are applied to driving our growth. Our growth drivers in the innovative side. I said, Austedo is up 51% today. The company in local currency is up 4%. So I think we've set ourselves on a good track. We've got to keep doing this. And I think, as you said, this year is the year that we've got to start to show that we can return to growth. I don't think, we're going to, suddenly pivot, but we've got to start to show incremental improvements in our business and in our portfolio mix. Our generics, we've communicated that we want to make that a powerhouse, make that a really focused generic business where we bring complex generics to the market and where we have a great supply chain. We're working hard to do that. And in the meantime, we're supplementing that and growing our innovative business. So I believe, Teva has a strong future, and that's what we're focused on. And that's why I think that it's important that we keep delivering these numbers. And we're confident that Austedo will hit $1.2 billion this year.
When you talk about shaping your future there, Richard, there have been reports that you could potentially be looking at selling your API business, your active pharmaceutical ingredient unit. Is this something that is being considered given what you view the future of Teva here down the line?
So what we've communicated about TAPI, our API business, you highlight there, is that we're actually going to move it as to a standalone business. Why are we doing this? Well, it's the second largest manufacturer of API in the world, and we've sort of had it under different parts of our business. And the API market's growing at 7%. And what we've done in the past is strategically use TAPI to feed our generics business. What we want to do now is give it the freedom to operate on a global market. We think that's going to allow it to grow what is already $1 billion business significantly, and that's going to help our growth story as Teva. So that's what we're mainly focused on. I think what some of the rumors are generated because people see TAPI as a good business with a lot of growth potential. But we do as well, and that's why we're focusing on making sure it's standalone and can focus on driving growth itself.
Richard, you talked about sort of pivoting to more of a higher risk pipeline, but we know the industry has felt the pressure from IRA, Medicare drug pricing. What are you thinking about in terms of strategy, and how do you strategize so you don't necessarily become a target on that?
Well, look, I think it's always been an evolving landscape and a moving landscape when it comes to regulation. And so I think what we're doing at Teva is we're focusing on science, bringing good products to the market where there's high unmet medical need, where patients need these products. I mean, you mentioned Austedo there. There was no treatment for tardive dyskinesia and Huntington's disease before these products came to the market. TL1A is going to be directed at ulcerative colitis and Crohn's disease, where there's no real satisfactory treatment. So I think for us, we want to actually bring these medicines to the market to help these patients. The IRA and some of the other things that are happening, we will have to navigate those because they will become part of our ecosystem. but that's not going to stop us bringing valuable medicines
How
to
do
the
you
market.
navigate that, though? When you think about where the targets could be, how do you navigate around that?
Well, I think firstly, it's coming now. So for the products we've got, we can't navigate. We just have to accept in our financial forecasting that the IRA potentially could come at some point, and then we've got to financially plan for that, what that does, and how we deal with that. And we'll deal with that with bringing more innovative products to the market. We'll deal with that with growing our generics business to a powerhouse. That's how we deal with that. So I think, I think it's frustrating because I do think it puts a dent on the enthusiasm to drive innovation. And it creates more challenges, which is a very costly part of our business where we have many failures in the pharma biotech industry. We invest a huge amount in innovation and we don't turn over many aces. I think people forget that. But it's become reality, so we do have to navigate it. And for our current molecules, we'll just have to accept that's going to happen at some point if they reach a certain revenue. And for our pipeline, I think we are a company that has great antibody engineering capabilities, and so that's where the majority of our pipeline will come from. And I think at least for the short term, that seems to be excluded.
Richard Francis, CEO of Teva Pharmaceuticals. Good to have you on today. Appreciate the time.
Thank you very much. Goodbye.
Ferrari shares pulling back despite reporting better than expected results and also raising its guidance. Pras Subramanian has been following that story for us. And Pras, we're still looking at a drop of just about 1% despite what looks like pretty robust demand for its vehicles.
Hey, Shauna, yeah, the Ferrari just beat on earnings and boosted guidance, but it's not far enough for investors here. They adjusted they boost their adjusted EBITDA on revenue, sales up 32% from a year ago there. So a good quarter for them, good guidance boost, but some analysts like Dan Rosk at Bernstein saying the guidance boost wasn't enough. The investors wanted more. After all, this stock was up 46% year to date. So a lot of gains or maybe some money taken off the table. But Ferrari for itself, again, like last quarter, this quarter, they had more personalizations, more custom orders. That's great for profit margins. And you have new vehicles like the Purosangue SUV and the Daytona SP3 supercar that are beginning deliveries next in this quarter. So that's all good news for Ferrari, potentially a surprise there in Q3 as well.
Pras, we also learned a little bit more just about the costs here. Ferrari adjusted its cost for Formula One, its F1 team. What do we know there in terms of what they're expecting from their team this year?
Yeah, so unlike other automakers, Ferrari actually makes money from their F1 team, I believe it or not. They operate that as part of their business. And they said that adjusted costs from the F1 racing team means that the company will see lower costs there due to a revised Formula One in-season ranking assumption. So what this means is that they think the team will do better. And then the better you do, the more money you get from the prize pool. But here's the thing, though. The team right now is ranked fourth in standings, well below the second place where it was before last year. And right now, Mercedes is pretty kind of lodged in there at number 2 level pretty closely. So it's kind of hard to see how Ferrari can actually do that. And analysts were questioning that. But last weekend, Charles Leclerc, F1 fans know the Ferrari race car driver, he got a podium finish last week at Belgium. So, he's coming into form there. But as Ferrari fans know, strategy isn't the best kind of thing that they do there. And a lot of fans have been crying, Mamma Mia, for some time now. So we'll see.
Brad, you got that in there. It's been a busy day on your beat today. We got news from Toyota as well, kind of going back to its roots with its new hybrid truck. What are the details there?
That's right, Kiko. The iconic Land Cruiser SUV is back. This is a truck that dates back to 1958. It's actually the longest running nameplate, they call it, in Toyota. So now it's coming back. It was discontinued for 2 years. Back now in a slimmer, boxier, more heritage-looking form. It's a 2-row SUV here, not a larger 3-row. So that's gonna be a big difference from last time. But here, that's better for off-roading, a smaller footprint, better for that kind of activity. So, but like you mentioned, also coming with a new hybrid powertrain, a mild hybrid setup here. 300 plus horsepower from a Turbo 4 along with electric motor combination. So it's pretty good there. Toyota did not give details on the EPA estimated mileage, so we don't have that here, but it's got to be more likely better than the V8 car that was there before. And with prices starting around $55,000 US, it's almost a 20 grand cheaper than the outgoing Land Cruiser. So I think it's a good value proposition for those people looking for like a mid-size SUV with a lot of curb appeal.
More affordable there. That might help attract some potential buyers at some point. All right, Pras Subramanian, thanks. Well, coming up, the 10-year Treasury yield hitting its highest level since November, and stocks don't like it. Is it time to start rethinking your equity exposure, or is it simply a case of being more selective? We will discuss next.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
We are just minutes away from the closing bell on Wall Street. The sell-off accelerating into the close. Let's bring in Jared Blickery, who's here to take a closer look at what's moving. Jared.
I think the critical question for investors is this a one-off? In other words, did we have the conditions ripe for a sell-off already in place, or is this Fitch decision a harbinger of more to come? In other words, is it a bigger catalyst for the markets than maybe is apparent today? Now, I think it's instructive to look at the losses we're looking at today. These are more than we've seen recently, but by no means are they catastrophic. Tech, communication services, and consumer discretionary, these are the three best performing sectors of the year. And those are also, not coincidentally, the mega cap sectors. And then you also have energy and industrials. Well, guess what the leading two sectors are over the last 2 months? Industrials and energy. And look what the top sectors are year to date. And that would be those three mega cap sectors that we were looking there. So it looks like we're simply giving back recent gains from some of the most profitable trades that we've seen this year. So taking profits, maybe that's one excuse. I don't necessarily like the term, but I want to look at the bond market because the conditions were already there in the bond market to suggest that we might see some weakness. Here's a 10-year T-note yield. It's up past 4% once again. We've seen it hit this level 3 other times going back to last October. Before that, you'd have to go back over a decade, I believe. But you take a look at what's happening now, bond volatility is also up. And that's something I've been warning about. Despite the low levels of equities volatility, the bond volatility is actually at fairly elevated levels. Here's a 3-year chart. You can see still in the middle of its range there, even though on a year-to-date basis, it is still down here. Now, if I put some candlesticks, you'll see there was a small uptick today in bond market volatility. That market closed at 3 p.m. Eastern. Also, finally, want to take a look at what's happening with the US dollar index. That has been racing higher recently. This is another year-to-date look. Let me just put some candlesticks here, take the candlesticks off. I was talking to J.C. Peretz earlier today. He said the dollar index above 102, not going to see equities performing well. And here we have above 102. So it looks like the conditions were already in place to see a potential sell-off, and maybe Fitch was just a catalyst here.
All right, Jared Blickery, thanks so much for breaking that down. Let's talk about how to play all of this because Wall Street also walking back recession talk today. Economists at Bank of America saying that the U.S. will not enter a recession and instead experience a soft landing. This comes after Fed staff also revised their projection, saying something similar. So how should investors navigate their portfolios amid this reversal and also the turmoil that we're seeing play out in the markets today following the downgrade of U.S. credit by Fitch? We want to talk about some picks and some stocks to avoid. For that, we have Dory Wiley, Commerce Street Capital CEO and President. Dory, it's good to see you here. So I think a lot of investors are trying to figure out where to place their money right now. Let's start with two of your picks, two smaller banks that you like, Connect One Bancorp and PPAC Gladstone. What's the bull case for these two smaller banks?
Well, I think there's an industry play here and then a stock-specific play. On the industry of banking, I think you got to wait in, you can't dive in. You know, we're all cautious about a commercial real estate refinance wave, asset liability risk, liquidity risk, et cetera, is what happened in April over those kind of things. And the market's clearly telling us in July that it is. Banks rallied, you know, big tech and did very well in July. So I think there's some, I would be real careful in what kind of banks I got into. So these two picks I like a lot that are in the New York area and New Jersey. They're smaller community banks. They're picking up on the failures of Signature and First Republic and Gathering Business, but they're very strong banks as well. They're pushing 8+9% capital. Both about 25 to 30% more than the percentage capital that JP Morgan has. At the same time, they're extremely cheap, trading very close to to tangible book value. They got great management, great growth prospects. They're very conservative on their credit underwriting. I think those are nice conservative plays in the banking industry. Just in case things were to go wrong, these banks actually would do better when things go wrong because they're so strong in capital.
Another name that you like, Texas Capital Bank shares. How does that fit into that checklist you just talked about which banks are positioned the best?
Yeah, so Texas Capital I threw in there for the same reasons. They're very strong in capital. They came into this last year actually shrinking and changing their balance sheet, changing their strategy under a new management team. But because they're here in Texas and this economy is extremely robust here right now, they're really positioned more than I see a lot of banks to take advantage and grow should things get worse. If things get better, then they should do fine too. They just got to keep continuing this transformation that they're going through. And the market seems to be waiting to see if they can do this, but I think they're probably worth the bet that they can do this. They've got really good quality people there. They got a good management team. I expect them to do well, and they trade as cheap as any bank on the market right now, pretty close to tangible book value. And they're running just under 10% tangible capital at the holding company, which is fantastic.
All right, so Dory, you're seeing some opportunity in some smaller banks. Let's talk about what you're saying investors should avoid right now. One of those names is a name that I think nearly everybody knows, and that's Disney. We're going to hear the results from Disney next week. Clearly, there's a lot of challenges when it comes to Bob Iger and what exactly he sees as the future of Disney right now. But what's your sell case? Why are you avoiding them at this point?
Well, they seem, very out of touch with the politics of their state. They seem to be out of touch with their customers. They seem to be out of touch with their market, and they seem to be losing their touch. And it's one thing if you can still perform if you're going to isolate and kind of play politics, if you will, on the woke business. But they're putting out a stream of a succession of movies that are starting to fail. They're just not doing very good. And so they're getting a track record of failure here that really concerns me. They've had trouble with a lot of cancellations in Disney Plus, a lot of controversy with the governor. I just think it's not a good thing to be caught up in when you've got all this turmoil at Disney. So I would avoid them for a while until they can show me that they've got a smooth path to success.
And finally, another stock you don't like, Tesla. Is this a valuation concern? If so, at what price point would you get in?
Oh, my gosh. I'm not sure you can value Tesla. The thing is I hate to say anything negative about him because I'm actually become a reluctant fan of Elon Musk. And I really appreciate him honorably stepping up and maybe being forced to do the Twitter deal. And he's really going through some massive change and actually, it's pretty incredible what he's been able to accomplish so far. So I wish him nothing but the best of success. But that stock is it's a popularity stock. It's a trend stock. It doesn't trade on fundamentals. It's way overvalued. And so I don't play in Tesla. It's too volatile and it doesn't follow any fundamentals at all. It's a popularity contest or a meme stock, and I just stay away from it. I think it's dangerous.
Meme stock. All right. Dory Wiley, thanks so much for laying out your picks and your icks for us. We look forward to talking to you again soon. Well, coming up, the closing bell on Wall Street. We're checking in on the latest market moves and also the top trending tickers. Stay tuned. The closing bell on Wall Street. Let's do a check of the market sponsored by Tasty Trade. We're looking at sell-off across the board following Fitch's downgrade of U.S. credit rating here. You're looking at the Dow closing just shy of the lows of the day, off just about 350 points. The S&P tracking back towards that 4,500 level. The Nasdaq having its worst trading day since February, looking at losses of just over 2%. Technology, communication services among the worst performing sectors of the day. Also consumer discretionary among the biggest decliners. The only sectors closing in the green for today, consumer staples and utilities. Looks like those two are the only ones eking out gains. All right, let's take a look at some of the big movers. First up, AMD. Shares closing lower this afternoon. Wall Street is not sold on the company's second quarter earnings. Several firms, including Bank of America and JP Morgan, saying that the company may be nearing the peak of its rally. Bank of America specifically saying that the company is too fixated on the acceleration of its AI business. AMD posted better than expected results in the latest quarter. CEO Lisa Su saying that she does see a recovery in the PC market. That, of course, would help AMD. Now, Josh, we also have to point out that semiconductors were among the hardest hit in the broader trading action today. When we take a look at some of the risk-off bets that we were seeing from traders following that downgrade from Fitch. But again, a notable decline for AMD, and AMD among the worst performers in the chip space.
Well, it's the AI story, right? So you take a look at AMD year to date, up over 80%, right? It's one of those high-flying semiconductor stocks in the AI story, like an NVIDIA. And when you look at what they're sort of promising with AI here, we've seen this trend throughout earnings thus far. If AI is not currently contributing to revenue, if you can't say that this quarter it helped, some of those stocks are trading off a little bit and giving back some of the gains that we've seen from the year, because a lot of the story here and what a lot of the street analysts were talking about, a lot of those people still putting buys on AMD after earnings are saying, well, wait for 2024, wait for 2025. AMD saying that its data centers could be at $150 billion in revenue by 2027. The projections are still there. The story hasn't changed. It's just not exactly coming right now. And if you expected it to come right now, then I guess maybe you're taking some profits today.
Yeah, and this was a total reversal from what we saw initially after the earnings crossed yesterday. And even after that conference call, the earnings call, was held, because there was a lot of excitement about their plans around AI and what they were doing in the space. The fact that they were laying out these very lofty goals, 150 billion, like you just mentioned, by 2027 when it comes to AI accelerators in data centers. I initially thought that the street's reaction was, hey, they could be a real viable competitor here to NVIDIA, maybe potentially take some of that market share, although the tone, though, has seemed to shift today when we're looking at a loss of just about 7%.
Right, and you also have NVIDIA off 5% though today too, and I think that has been the tone, Shauna, right? Is AMD the next player? So it'll be interesting to see, I think, over the next couple months, maybe not on the day of a Fitch downgrade of U.S. credit, how AMD's stock reacts, right? Because I think it might be a little different over the longer term. But I want to take a look at shares of Generac closing deep in the red, the worst performer in the S&P 500 today. The company warning of sharp sales declines in the second half of the year, blaming weak consumer demand. Generac did beat revenue expectations for its second quarter, despite sales falling 23% from a year ago. But really the key number here, Shauna, was that guidance for the next quarter. For the full year, they're expecting sales to decline between 10 to 12%. They had initially been expecting sales to decline between 6 to 10%. So they think it's going to be worse than initially feared. That's never good in terms of guidance.
It's never good. And it was also interesting that they have weaker than expected residential sales, just in terms of their guidance and what they're expecting here going forward. KeyBank did note that some of the weakness that we have seen in their residential business, some of that is being offset by strength in commercial and industrial products. But you're right, the guidance, the big driver on this move that we saw in the stock today was the biggest decline, I believe, that we have seen in Generac since October, when we take into account the fact that the stock dropped over 24%. Expectations were very high going into this quarter. The stock was up just about 15% year to date, and Generac unable to meet those.
It's interesting when you think about the commentary too, right? CEO Aaron Jagdfeld he called part of Generac's product in here backup power solutions, and talking about consumer demand being down in something that's backup power solutions. And we think about overall spending here, just wondering where consumers are willing to maybe not spend. And if it isn't your first generator or your first source of power, maybe until your power goes out, you're not buying a backup generator in the current environment, as people do spend a little bit less money interesting point, I thought.
Yeah, that is a very interesting point and important to point out, especially in the climate that we're in right now. All right, let's also take a look at ELF shares closing higher after the company raised its outlook and profit came in nearly double what analysts were expecting. Shares have more than doubled year to date, and their CEO saying that the company is, quote, just in the early innings of unlocking their full potential. He told us that after the last quarter as well. We're looking at significant gains, so doubled since the start of the year, more than tripled in the past year. Their guidance was impressive, and Bank of America even noted that the raised guidance they felt was still conservative. Really speaks to the explosive growth that we've seen.
Revenue up 76% from the same quarter last year. I mean, that's just a massive number. 18 straight quarters of net sales growth and market share gains. They beat the street the street had been expecting $184 million in revenue. They came in at $216 million in revenue. When we've seen stocks move more on sales this quarter, it seems like that's been the driver more so than EPS. And you get a big sales beat like this, and you project more sales. Not shocking to see the stock flying higher here. And another thing I'll point out that we always talk about with these retail names, ELF talking a lot about digital growth, which I found very interesting on this call. They're talking a lot about how they're getting more consumers to buy digital, getting them in the game that way, and then you can get people like digital sales. It's a hot thing in retail to be able to get people in that ecosystem and then continue to sell to them, offer new products. So it's sort of a growth engine to watch for ELF there.
Yeah, you almost need to be in that position in order to excel in this type of environment. But again, I think ELF is very well positioned given the fact that many of their products are on the lower end of the price range. So if people are still spending, many might downgrade, or I guess trade down, you should say, to an ELF product just because they're better priced. And if they're looking
but
at
you still got to buy the makeup.
Still got to buy the makeup.
People are still buying makeup no matter what.
We'll still say that makeup's recession-proof, right, Josh? Thanks so much. Let's get over to Akiko with Qualcomm earnings.
Yeah, we are seeing shares of Qualcomm under pressure here on the back of their numbers. And this is really about a weaker forecast, as well as concerns about a slump in phone sales continuing there. It came in above expectations in terms of earnings on $1.87 a share. The estimate was $1.81 a share. Revenue, though, was a miss, coming in at $8.44 billion versus the estimate pointing to $8.51 billion. Now, smartphone chip sales, this is something that we've been tracking really closely with Qualcomm, given that that is the biggest revenue driver for the company. That was down 25%. And Chana, we've been talking so much about the pullback that we have seen in smartphones. The latest data coming out of IDC pointing to roughly almost 10% decline globally. Qualcomm clearly getting hit on that as well, and really indicating in this release that they expect that to continue to be a drag. Now, some comments coming through from CEO Cristiano Amon, really highlighting the AI potential here. And when you talk about Qualcomm, it is about AI and the use of that on smartphones. He says specifically as AI use cases proliferate to the edge, on-device AI has the potential to drive an inflection point across all of our products. Qualcomm remains best positioned to lead the transition given the unmatched accelerated computing performance with the power efficiency of our platform. So that's sort of the positive they're highlighting. But at the end of the day, this is a company that really is driven by those chip sales in smartphones, and that those upgrades just haven't been, the deliveries have really been declining as well. And that's hitting Qualcomm in a big way.
Yeah, certainly renewing some of those concerns out there just about the health and the strength of the smartphone industry right now that's contending, like you said, with one of the worst downturns that we have seen here. So the fact that maybe the worst is not over, or it's not recovering nearly as quickly as maybe analysts had anticipated. We're seeing that reflected in these results today. Also, demand in China, the biggest market for phones, that hasn't returned to the projected levels. And that region gives Qualcomm about 60% of its sales. So weakness there in China, also weakness obviously overall in the smartphone industry, a huge headwind for Qualcomm. We're going to dive deeper into these results on the other side of the break.
Well, Qualcomm earnings just hitting the wire. Earnings coming in above expectations at $1.87 a share. The estimate, $1.81 a share. Revenue, though, was a miss, coming in at $8.44 billion versus the estimated $8.51 billion. And we have seen shares of Qualcomm moving to the downside, at least in the immediate reaction we're seeing in after hours here. Let's bring in CFRA analyst Angelo Zeno for a breakdown of the numbers. Angelo, we knew Qualcomm was facing a lot of headwinds already, especially with the exposure to smartphones and the slowdown we've seen there. What stood out to you in the numbers that we just got?
Yeah, I think overall the numbers look pretty disappointing to us. And I mean, you kind of highlighted the point that they did kind of meet on the bottom line for the June quarter. The guidance for the September quarter, at least on the bottom line, also looks okay. But what's most important, we think, is on the top line side of things. There was a slight miss in the June quarter, and the guidance on the September quarter, in our view, just kind of implied just really no kind of acceleration on the growth side of things. And you typically see some sort of improving seasonality as you go into the September and December quarters. And the fact that you're not seeing much of a pickup here really points to some of the, we think, inventory overhang that they continue to see on the smartphone side of things. And I will say this, as far as smartphones are concerned, I mean, listen, the declines, you're looking at a run rate in the June quarter, probably at, essentially decade lows. But, the Apple side of things should be holding up better than the Android side of things. Of course, Qualcomm very exposed on the Android ecosystem, where we think you're probably seeing the most egregious type of headwinds as far as inventory overhang is concerned.
Yeah, the broader trend has been moving to the downside. I was just pointing out some IDC numbers that came out recently that pointed to about, 7.88% decline in worldwide shipments of smartphones. So Qualcomm sort of indicating, that pressure is going to continue. What are you seeing, at least in the medium term? And what do you think is the catalyst to turn that around?
I think, I do think you need China to come back, right? So when you kind of look at the handset numbers, I think it was down about 25% on a year-over-year basis. And you just kind of gave some of the IDC numbers for the June quarter. So that kind of tells you how much Qualcomm is really under shipping the market right now, right? So we do think, again, a lot of those issues are coming from the Android ecosystem, specifically out in China. But they also did, Qualcomm last quarter, hint towards a large customer essentially digesting orders to a large extent, which we believe was Apple. So, you do need to see some sort of improvement on the end demand side of things. And we think particularly you need to see that come out of China. And hopefully, you start seeing increased momentum also out of India, which could help on Apple's side of things. But overall, this really comes down to kind of improvement from a lot of those China vendors out there, which Qualcomm is heavily exposed to.
Yeah, so let's talk about that, because China continues to be an overhang for Qualcomm. You pointed it out. Revenue, more than 60% comes from China. On the one hand, you've got the concerns about demand and the pickup in that market. There's also the concern about potential political headwinds. Is Qualcomm going to be caught in the crosshairs like Micron? How do you think investors should be looking at those two storylines coming out of that market, just given how much exposure Qualcomm has?
Yeah, I think you always have to be worried about kind of geopolitical landscape out there as far as Qualcomm is concerned, right? You also have to be worried about the fact that, Taiwan Semi kind of is their kind of key supplier out there. And you never know what's going to happen in terms of the geopolitical side of things over there. So that is kind of another risk out there in terms of the Qualcomm story. We can continue to tell investors to stay away from the Qualcomm name, largely because of some of the uncertainties as it relates to the Apple business as we kind of go into fall of next year and thereafter. But in addition to that, I mean, you kind of highlighted some of those other concerns to be mindful of, China, of course, being a big part of that.
And finally, Angelo, I guess the one positive you could point to with Qualcomm, at least they see upside in this investment in AI, highlighted in this release with Christian Oman saying that essentially Qualcomm is best positioned to lead this transition. He's talking about integrating AI technology specifically in smartphones. How big of a revenue driver is that going to be? Yeah,
I think that's a really important question to ask them and try to figure out, right? Because As far as the AI story is concerned, I mean, we continue to believe, at least over the next kind of 1 or 3 years, the real opportunity remains on the data center side of things, as far as compute intensity is concerned, as well as the networking side of things. And that's not really an area where Qualcomm is exposed to. So when I start thinking about kind of some of Qualcomm's opportunities, yes, there could be opportunities on the smartphone side of things. There could be opportunities in things potentially like, spatial computing or what have you, or even kind of on the autonomous driving side of things inside the car, where they have, autonomous or cars are about 5 to 7% of their revenue right now. So there are kind of opportunities out there as far as AI is concerned. But as we kind of look here over at least the next 9 to 12 months, we're hard pressed to really see much of a story coming to fruition as far as AI is concerned for Qualcomm. So you really need to be patient in terms of this name if you are a long-term believer in Qualcomm.
Okay, patience the key there. CFRA's Angelo Zeno, as always, good to get your takes. Thanks so much for joining us today.
Great, thanks for having me.
Robinhood out with their quarterly results. Shauna, the stock under heavy pressure right now. What do we have?
Yeah, Kiko, we're looking at losses of just about 6%. Revenue did beat expectations, coming in at $486 million. Estimate was for $472 million. The company was expected to report a loss of 2 cents a share. Earnings came in at 3 cents a share. And the company highlighting in this report in Q2, we reached a significant milestone by achieving GAAP profitability for the first time as a public company. Now, CEO Vlad Tenev went on to say, guided by our bold product roadmap, we're continuing to innovate for our customers, grow assets, gain market share, and change the industry for the better. But that's not enough for the street, because you're looking at the stock under a significant amount of pressure right now. One of those reasons, monthly active users, that decreasing once again. And this has been a trend here for Robinhood over its past several quarters. This past quarter decreased by 1 million to 10.8 million. That missed the street's expectations of 11.7 million. A couple of other things to note within this release. Net revenue, like I said, beat expectations, up 10% sequentially here. Total operating expenses for the year, that was revised lower to $2.33 billion to $2.41 billion. Robinhood also highlighting a couple of new products that they have launched recently. One of those being 24-hour market, which is now available to all customers as of the last month. And we know Robinhood has tried to bring new products to market in order to entice more users onto their site. They're trying to do everything they can to halt the slide that they are seeing with some of those new offerings. But it looks like as of right now, that has not been able to do the trick here, with once again monthly active users at Kiko declining by about 1 million to 10.8 million.
Yeah, I mean, this is a company that is very much in transition, as you point out, really trying to diversify its revenue stream. And they've really touted some of these new products, whether it's their product for retirement, whether it's Robinhood Gold, which is sort of similar to a high yield, savings account for some of their best customers. At the end of the day, though, it is that number that you highlighted, Shauna, which is the monthly active users, that being down 1 million, certainly significant. Investors not liking it with those shares down now more, or roughly 7%. Let's do a check of the market sponsored by Tasty Trade. Pretty much a red day across the board today, as we saw the Dow down roughly 350 points, the S&P 500 down 63, and the Nasdaq down 300. The big driver today, of course, Fitch downgrading the U.S. credit rating there. That's sparking the sell-off and risk-off that we saw today. We'll be right back.
Intel bounced back in the second quarter with a return to profitability following two back-to-back quarters of losses. Revenue fell 15% year over year, but the chipmaker did give more upbeat guidance than expected for the current quarter. Intel CEO Pat Gelsinger joins me now. Pat, always great to get some time with you. In terms of the Intel turnaround, is it fair to say that the worst days that I think investors saw from the prior few quarters, is it over? Can you confidently say that?
Hey, thanks, Brian. Always a pleasure to be on Yahoo Finance and to chat with you. And yeah, we had a very solid Q2 and beating on the top line, beating on the bottom line, exceeding on both our PC business as well as a bit better than we expected in the data center business. So I just say we finished the quarter feeling really good, good response from investors as we rolled out the news. And I do think we've seen the worst. And obviously, the PC inventory levels are now healthy again. And we're seeing the demand signals. We think we still have a little bit of inventory on the networking and the data center to fight through in the third quarter of the year. But I really think the worst is behind us at this point, and our raise to the guide for Q3 really portends to a more optimistic future. So super proud of my team and making a really good quarter happen for us.
Pat, you told me 3 months ago that green shoots were starting to form, and it looks that way from the guidance. So is it okay to say that those shoots are now morphing into plants?
Yeah, they're getting a little bigger and a few more shoots as well. But I'll say, if we think about that, getting the client, the PC business, healthy, right? Good inventory levels, we're back to historic market share levels. So I'd say, that clearly has gone from a green shoot to a plant at this point. Data center, hey, we did a little bit better than we thought we would in Q2. The product roadmap, Sapphire Rapids, Gen 4, Gen 5 with Emerald Rapids, looking to appear Q in Q3 a bit ahead of schedule, and the roadmap for next year. So I'll say we're still sort of at the green shoots level there. We had a big uptick in our AI pipeline, particularly led by our Gaudi product line. 6x in the quarter, $1 billion plus pipeline. So I'll say that's still in the green shoot phase. So overall, good green shoots and good execution on our process technology. The all important, do I have the best transistors in the world? And starting to see some good momentum in the foundry business. So I'll say, we have at least one good solid plant and plenty of green shoots other areas in the business.
Fair enough. I could deal with that. So I want to talk about AI in a second. I have to make sure people watch this whole interview, Pat, so I'm going to save it to the end. Let me go back to the state of the PC market. What does the recovery look like in terms of PC demand, and how do you see it playing out for later this year?
Yeah, so we're expecting, nice quarter-on-quarter improvements in it. Part of that is by the inventory level adjustments that are now behind us. We're now to healthy inventories at OEMs and distributors. But our product line is good. We gained market share, again, we believe, and ushering in what we call the AI PC, with our next generation product. We call it Meteor Lake is the name for it. We have new capabilities in AI built into the product that are going to allow you just to do cool things in your PC, and being able to do real-time language translation, be able to do transcription in real time, video effects, all of these type of things, new gamer models. So we see that being like the Centrino moment for bringing Wi-Fi into the PC 2 decades ago. We see this AI PC as ushering in a new class of applications, major application upgrades and ISV excitements, and we're leading the way with our Meteor Lake product in the second half of this year. So healthy and great opportunity in the future.
Pat, why doesn't the street give you enough credit for what you are doing in AI? And I bring that up. You just told me you have $1 billion plus pipeline in AI-related products. What do you guys need to do at Intel to get that word out?
Well, I think there's two things going on, Brian. And, in this, I think we have yet some things to prove in the marketplace. But one is there's the accelerators, right, that have now, become the way that people are executing their Gen AI training environments today. And so there's a surge of interest where everybody says, hey, I got to get my Gen AI models up and ready to go in my clouds or in my enterprises. And a lot of that's going to the accelerators. So does that become a depressor of Xeon demand, where we have a very big and healthy business. So that's one effect that people are trying to understand in the market. And then the second effect is more aligned with your question is, okay, Intel, are you going to participate in that accelerator market? And, I'll just say we haven't been as aggressive out of the chute as we should have been. And now with our Gaudi product line really starting to get interest in the marketplace, customer pipeline is building very rapidly. And we have a very robust roadmap. Gaudi 2 is shipping in volume today. Gaudi 3, I just received first silicon on it, so it's sort of like a 2x level of capability, and we'll be launching that for volume shipments next year. And then our 2025 product is already well underway. So 23, 24, 25, we're showing up. We're starting to make a impact in the marketplace, but we have to prove it because we have a clear market leader who's executing very well. And I also see that as a potential foundry opportunity, that we're actually going to become, a foundry supplier for some of those AI chips as well. So we see the potential to be a provider of those chips, those AI accelerators, but also a foundry for those chips at both the wafer and the packaging level.
A couple of your competitors, Pat, I think you may be referring to NVIDIA, maybe or maybe not, but a company like that, they just had almost a $4 billion reset higher in guidance. But I hear everything you're doing in AI now. I mean, do you think you will have a similar moment next year as these AI accelerators that you're making get into the market of people, and the street needs to reset its expectations for your company in terms of how much profit you can earn and how much revenue you can earn?
Well, I'll just say, NVIDIA's done a good job in this space, and they've really led the way. And as I like to say, they worked super hard and they got lucky in really being at the right place at the right time for some of these algorithmic breakthroughs. And the AI space is still fairly young, so I think there's a lot of opportunity for us looking forward. We're starting to show up, winning customers and getting real enthusiasm because the market wants alternatives here. And so we're hearing our customers really say, okay, how can you show up to give us good alternatives that are more cost effective, power efficient, capabilities that the competition doesn't offer? So I feel good about our roadmap. I do think that we will start to incrementally get more credit for that as we go into next year, but I have to execute that well. So I think in this regard, I think this is one of those green shoots that another quarter or two under our belt, I think we'll start getting credit from it from the market's perspective.
I know you're very much a globetrotting CEO. You're constantly on the road, visiting other countries, pounding the table for Intel's business. We just had a credit rating downgrade in the U.S. As a global CEO that has many connections overseas and who has been doing this for a while, I mean, what do you think this downgrade says about the state of this country, and what does it mean to a business like Intel?
Well, I'd say overall, is anything going to displace the U.S. dollar as the global currency for trade? And I just say, I don't see anything on the horizon, for that. So at one level, I just sort of say, okay, it's a downgrade. Hey, there may be some implications on cost of debt, but I really see that as somewhat minor. I view it more as a statement. Hey, get our debt situation under control in the U.S. and the credit agencies are starting to get a little bit more, concerned in that regard, right? But I'd say in terms of the impact of me running the, Intel as a business, or CEOs like myself running global businesses, I don't see that much real impact from this change. That said, hey, as the more stable global currencies are, the more they see the U.S. right as that leader that everybody can bet on, as we get our own inflation situation under control, and the ability to now start being that leader of global trade again is something that we've put a lot of emphasis on. We want open global markets. We want to be able to sell our products globally. I think all of these tie together to say, this is what it takes to run a great business today. It's a globally interconnected market. We want balance and resilience in the supply chains, and we want access to global markets.
All right, let's take a look at some of the biggest stories, other stories that we're keeping an eye on of the day. We had Josh Schaefer, Brooke DePalma here to break it all down. And guys, let's start off with the story that caught my eye, and that's the latest out of Amazon. They're really doubling down on their grocery business, and here's what they're doing. They're revamping it to some extent. So the Fresh option, Amazon Fresh, is now going to be offered to non-Prime members, something that has not been the case in the past. They're also going to be redesigning some of their stores, revamping their stores, testing automated warehouse features here. This is all in an effort to grab a bigger piece of the grocery market. And there has been a number of estimates out there. UBS, one of the latest on the street to come out, saying that they estimate the U.S. grocery business is about $1.5 trillion. And Amazon is in about 5th place when it comes to that. So they need to do something. We'll see whether or not this really moves the needle here for them.
Yeah, and also it's interesting to see that, I mean, Walmart, Kroger, Albertsons, all ahead of the game when it comes to, as you can see right here, when it comes to the grocery space. And Amazon, really, when they acquired Whole Foods, they really thought they were going to be a main player within this space. And they continue to struggle to grab market share. And really, that Just Walk Out technology, I know we were talking about right before, really not as optimistic or not as encouraging as maybe they thought.
I thought of an innovative idea when we were just showing the market share there, guys. 3.5% for Publix. Maybe Amazon just needs a pub sub. But actually, like, I think sometimes like we overthink groceries to some extent when it comes to online orders and things like that. I'm thinking about myself as a consumer and how I grocery shop. I grocery shop a lot. I go multiple times throughout the week because I just like going. And I like going and grabbing my things and picking stuff. And I wonder if part of this push for Amazon is to just become a little bit more of a normal grocery store by allowing people that aren't members to use Amazon Fresh to become a little bit more broader and consumer. We know there are a lot of Amazon Prime members, of course, but to broaden that out and just be a grocery store that people can go to in the same way people feel like they can order on Amazon. Yes, people order if they're Prime members, but you can still use Amazon online when you're not a Prime member. So that part of it sticks out to me, to be able to expand beyond the Prime membership.
Yeah, what I think is interesting too is that you still are going to have to pay a delivery fee if you're not a Prime member. And so in this environment where consumers are really looking to stretch their dollar, they're looking for value, will they necessarily go to Amazon Fresh as their first choice? I don't know. And I really think that's what they continue to struggle with. People don't think necessarily of Amazon Fresh as their go-to.
Yeah, and I also think that they're just up against stiff competition when it comes to the delivery side of groceries, right? I'm someone who orders my groceries all of the time. Josh, we're at a little bit different stages of life. If you have young kids at home, you don't necessarily have the time to be taking multiple trips to the grocery store.
I'm literally trying to find things to do.
But I think that this is a smart play just in terms of the fact so many people opt for Instacart. There's many other options that you can go to. So the fact that they are placing an emphasis on this, they're opening up to non-Prime members. I do think they do have a real opportunity here to increase their base. Whether or not those customers then are repetitive customers, that's a whole nother question too.
And it was interesting, I saw one analyst call it the last frontier for Amazon, right? The last frontier of the consumer, one of the only areas of the consumer they're not dominating. So I'm just curious what we're gonna hear in that earnings call tomorrow. Remember, Amazon earnings tomorrow after the bell. Shauna's gonna have you covered with it.
Of course we will.
What is Andy Jassy gonna say about groceries on that call? Announcements like this don't normally happen the day before earnings unless they're gonna probably try and talk about it a little bit on the call and play it up. So it'll be an interesting part of the story. I think we'll probably be watching the cloud story more, but I do want to move on to a different last frontier when we're talking about another tech company that's also reporting earnings tomorrow. So we have Apple earnings out tomorrow. And in my opinion, at least in the streaming space, the last frontier for Apple is sports. And we got a new headline out in the last 24 hours, Pete Thamel over ESPN, saying that the Pac-12 has now presented, so Commissioner George Kliakoff has now presented a deal to the Pac-12 teams that would allow them to be Apple be the exclusive streamer when they re-sign their deal after this year. Now, this comes as the Pac-12 has been losing teams. USC, UCLA, major name brand schools are going to be gone in a year. Oregon might be leaving. Colorado has left already and announced that they're leaving. So Pac-12 a little bit looking for some good news here, but it'd be interesting, Shauna, to me to see Apple pair up with a college conference and a smaller college conference at that. It reminds me more of that MLS deal. They're not getting the SEC.
Right.
You get Pac-12 football that, little bit of a smaller audience. You can sort of test things out, see how football goes.
Yeah, and you kind of took the words out of my mouth because I was going to draw that exact same comparison, right? They're getting into college football. They're getting that exposure. They're going for a smaller league, not one that's going to cost them nearly as much. So they get their footprint. They get some exposure there. Whether or not it's a good deal for Pac-12, that's also been debated out there, although we don't have to go all the way into college football here. But when it comes to Apple's play into sports, clearly, if they're looking at college football, we can see that they envision sports becoming a bigger part of their streaming offering, and where that goes from here in terms of professional sports, other larger college conferences, that's going to be the thing to watch.
Yeah, and speaking of that impact on Pac-12, if I read this right, Josh, I mean, Apple does not produce the games. So what does this ultimately mean for the cost to Pac-12? Will this investment, this partnership be worth it to them at the end of the day, or will it end up eating into their bottom line? I mean,
It'd be interesting to see sort of how it plays out, right? I think that really what it would probably do, hopefully at least for Apple, would be just get more subscribers, right? It's just getting more premium subscribers. And then I think when you think about the overall vision for Apple, and one thing I'm excited to maybe hear about on that earnings call tomorrow, is what happens with the Vision Pro headset and what the full vision is there. Because it's been really interesting to me to hear Bob Iger talk about that Vision Pro headset. And Bob Iger's looking for things to do with ESPN. And you've talked about watching an NBA game on that Vision Pro headset. When you start to get broadcast deals, you can do alternative broadcasts. You can play with that headset. If you're going to sell a VR headset, VR AR headset for $3,500, put me on the field. Let's do something cool with it. And I don't think that they're necessarily going to talk about that tomorrow, right? But they are going to talk about the future of Vision Pro and where they're going with it. And I think to see them build out that streaming product and have more pieces of content to put in the headset is part of the story here.
Right. Well, a company is always looking for new ways to fuel growth, and Starbucks tapping into cold in order to fuel that growth. Right now, Starbucks cold business made up about 75% of U.S. beverage sales in the second quarter. And behind that, of course, is the ice. Now, earlier this year, back in May, Starbucks hinted towards this nugget ice. And so regular cubed ice may be a thing of the past because they're introducing their nugget ice. It's like smaller pellet sized ice. Just wait to hear. Yahoo Finance spoke to CFO Rachel Jerry this morning. To hear more, take a listen.
We're in the early journey of what we call our nugget ice, and being able to put nugget ice in our stores. We've hit our highest volume cold stores so that we can actually support the capacity. Eventually it'll be piped into the stores so they'll no longer have to be, carrying buckets of ice. And so it's a better option for the partners and creates a better experience. But at the same time, our customers love it.
And really what's behind that drive is cold customers flocking to cold. We're seeing it continuing to be a headline within their earnings report. We're seeing ongoing innovation from them. And Sean is looking at me like I'm crazy, but this is a big bright spot for Starbucks.
Nugget ice. I mean, you said you were out on nugget ice. Are you actually out on the actual product or the name nugget ice?
Both.
It's not necessarily a Starbucks name, it's an industry.
I was going to say, it's industry name. The name is funny. I don't find the ice that chewable. It's supposed to be more chewable. I like to chew on my ice after the iced coffee, and I don't think that the nugget ice is that good for that. But just the fact that we're having this conversation, is Starbucks not one of the most fun companies to read through the earnings call? Like, they're talking about nugget ice. They're talking about foam maybe being a $1 billion part of their business.
Modifiers are $1 billion business.
Right. And then they're talking about the fact that 80% of people, or it was about 80% of people, right, are having iced coffee.
Right.
That was 80% of
their U.S. beverage sales.
Yeah.
Also in warmer months, I want to point out, but yes.
But that's, I just think it's interesting to sort of think about how people consume coffee. I'm still a hot coffee person.
You are, and and you buck the trend because she talked about it on that during your interview. The fact that it's really targeting the younger consumer, and we know that this is something that so many of its rivals have struggled to do. They want to do everything they can to attract that younger consumer. Starbucks, like you said, Brooke, very innovative, and they're normally ahead of the curve when it comes to some of these trends. So they're proving that nugget ice, foam, cold drinks, it's something that I guess Gen Z loves. I don't know, Josh, except for you, but majority of Gen Z favors the ice drink. But I'm with you. I'm hot.
It's a smart play too. If you're a business and you want to sell more coffees, people are more inclined to drink iced beverages in the afternoon, right?
Oh,
so you really play that up because then you can get a longer day out of it, and you get people to go and have a drink in the afternoon. Because I don't want a hot coffee at 3 p.m.
Cold beverages boosting day part sales for sure.
They are.
All right, but people might be ordering that Starbucks on DoorDash. They also reported earnings, and Shauna's going to tell you what happened with those earnings after the break.
are checking in on two names in the fintech space. Robinhood and PayPal both out with quarterly results today. Both stocks are under pressure here, with Robinhood shares down roughly 4%, PayPal down 7.5% roughly. Let's bring in Dan Dole of Mizuho America's senior financial tech analyst. Dan, we're seeing both stocks moving in the same direction here, but let's start with PayPal. Give me the headline that stood out to you the most.
Yeah, I'm still processing it, but I mean, the one thing that I'm seeing, which might be the reason why the stock is down, is that the take rate or transaction profit dollars are down. They were down 3% in the first quarter, and what I'm seeing here is they're probably down like 6 to 7% this quarter, and this is probably what gets people worried. It's kind of the interplay between the branded checkout, which is at a higher take rate, and the non-branded checkout, which is at a lower take rate, and that's why it's coming down. But that's what people are worried about.
So the branded checkout is really what I'm hearing from you is what the company needs to double down on. What do they need to do to get those numbers higher?
Well, they need to start growing the branded checkout faster. I mean, that's probably what the new management is going to do post Dan Schulman, is find ways to basically make sure that the branded checkout is growing faster, not losing share to Apple Pay. This has been sort of the key controversy. It's the highest margin business, and people, whenever people see kind of weakness there, I don't think it's weak, but whenever people see perceived weakness there, they start getting worried about PayPal, and that's why the stock is trading down.
Let's talk about another name that we've been watching closely here, which is Robinhood. You know, on the one hand, you've got a company that is sort of seeing the trading activity coming down. They've been trying to diversify with new product offerings. At the end of the day, it is about their active users, and we saw that number down 1 million. When you look at the new product lines, is that enough to bring some of these users back? How do they make this platform sticky?
Yeah, I'm super excited about Robinhood. I mean, I understand why the stock is down, and hopefully you can hear me well. There's people screaming for the last 2 seconds here in the background, but I'm really excited about Robinhood. I think the whole decline in users was very well telegraphed, right? If you think about it, they give you like monthly trading updates, and you saw those. So I don't think this is new news. The bottom line for me, and the reason I'm excited is, hey, you look at IRA. They've done like they got $1 billion already of IRA. 2, they beat revenues. 3, they're actually growing. You know, they become GAAP profitable. Like, I don't think there's any other company in the class of 2021 IPOs that is actually GAAP profitable. And 3, you know, the revenues are doing really well, and the ARPU is basically back to, I mean, it's not back to 2021 level, but it's the highest it's ever been. So I'm looking at like outside that headline, I'm actually seeing results being very, very strong. And to me, that's more important than just a data point on users that really is void of any context without something else.
Let's talk about the retirement offering you just mentioned. That is one of the big product offerings that points to the maturity of the company, or the company looking to mature beyond what has been traditionally been seen as sort of, day trade, the retail traders. We've known Robinhood traditionally as sort of the place for meme stocks, but where is that opportunity on the retirement front? How much upside do you see when you consider the customers are going after?
I mean, look, the sky is the limit, right? If you think about those 10, 11, 12 million MAUs and growing, I actually think over time they're continuing to grow. They will continue to grow, and they're growing internationally. Like, those people are young. They don't have like a real retirement solution. I think over time, as they grow together with Robinhood and they do more and more, this could be like the next Charles Schwab or the next TD Ameritrade, right? I think that's the opportunity. I can't quantify it in a number. We really haven't done sort of that bottom-up work. But think about it. Everyone has a 401k. They're going somewhere when they get jobs. At some point when they grow, when they grow up, they stay with Robinhood and they do it with Robinhood. I mean, this could be the next Charles Schwab. That's why I don't understand why people are worried about one data point. The stock should be up today, not down.
That's quite the statement, the next Charles Schwab, at least in terms of growth opportunity for Robinhood. So we are talking about these two fintech names. I know they're not apples to apples comparisons, but when you look at it from a stock investment perspective, what's the better play?
I think Robinhood right now. I mean, that's a great question. Kind of, no pun intended on the Apple versus PayPal, but I think Robinhood is the better play because there's like idiosyncratic momentum here, and they're small and they're growing and they're innovative. PayPal has a lot of opportunity, and I, obviously stick with my buy rating here. I just think that you need to see who the next CEO is to get more clarity on the strategic direction. I mean, Robinhood to me is a steal. I mean, that one should be, I think, the next Charles Schwab is probably a good way to put it. I was going to say the next JP Morgan, but let's start with Charles Schwab and then move on. The next, how about the next Yahoo Finance? The next Yahoo Finance.
Okay, maybe there's a competitor there. Mizuho America's Dan Dolev. It's good to talk to you today. Appreciate the time.
Anytime. Thank you.
Well, coming up at closing time here on Yahoo Finance, we're going to recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
Let's take a look at a couple of names that's trending after hours, all because of earnings. We have Shopify, Occidental, Robinhood, Etsy, and DoorDash. Kicking it off with Shopify, we're looking at losses of just about 2% here in extended trading. Now, the company beating on revenue of 31% growth year over year. Subscription revenue was up 21% on a year over year basis. The company cash flow positive for the third consecutive quarter in a row. This is a stock that's run up over 30% in the last 3 months. Expectations were very high going into this report, so we're seeing some selling action in extended trading. And Shopify also closed the day off just about 7.5%. Let's move on to Robinhood here. And Robinhood shares under a bit of pressure, off just about 4% right now. The company monthly active users missing expectations, 10.8 million. Estimate was for 11.7 million. That was declining from the previous quarter here. And you're taking a look at Robinhood, if we can pull it up on the screen. The stock has been under some pressure, obviously having a tough time here attracting and keeping their users with that disappointing number here. Year to date, though, we're still looking at gains of just about 52%. So the fact that they did miss on that key metrics, putting some pressure on shares in after hours. Let's head back to Occidental Petroleum. That stock off just about 2% in extended trading. Remember, this is the company that Warren Buffett's Berkshire Hathaway recently just upped its stake into about 25%. Earnings missed expectations. Revenue also coming in a bit short, falling 37% from a year ago. Year to date, looking at losses of just about 2.5%. All right, let's take a look at Etsy. That stock out here with results moments ago, off just about 5.5%. Third quarter revenue guidance missing the midpoint of the range, and that's enough to put pressure on shares here in extended trading. Second quarter revenue up 7.5%, better than expected. Services revenue was up 21%. Active sellers up 12% to 8.31 million. Buyers up 2.5% to 96.3 million. That was also better than expected. We heard from Etsy in this report. Etsy ads once again are a big driver here to revenue growth, but the stock's still off about 5%. Rounding it out with DoorDash, that stock on the move. The stock posting some gains here, up just about 4%. They raised their full year guidance here for gross order value. That, of course, is a critical point here in this report. That coming in better than expected for the second quarter. Revenue up about a third, up 33% on a year-over-year basis, beating the street's expectations at just over $2 billion, 2.13 billion. Orders also increasing 25% from a year ago. We're looking at gains of about 4%.
Well, it's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. It was a tough day for the market on the heels of a credit downgrade from Fitch, the agency cutting its rating from AAA to AA plus. But JP Morgan Chase Chairman and CEO Jamie Dimon calling it ridiculous and saying it doesn't matter much. Investors initially took the news in stride, but we did see selling accelerate into the close. The Dow snapping a pre-session win streak, down 348 points on the day. The Nasdaq was the worst performer and had its worst day since February. Well, some of the hardest hit names today, Chinese internet stocks. Regulators in China saying time on phones for children under 18 years of age should be limited to 2 hours a day. The Cyberspace Administration of China also proposed that kids not have internet access between 10 p.m. and 6 a.m. Finally, the Writers Guild and movie studios are coming back to the negotiating table. The two sides are agreeing to resume talks 3 months into the writers' strike. The meeting, slated to take place on Friday, will be the first effort to end the stalemate.
All right, time for what to watch on Thursday. Another packed day of earnings. Warner Brothers Discovery is among the slew of names reporting before the bell. The summer hit Barbie may provide a WBD a bit of a boost here, although that's more so in the current quarter. The company's debt load will be a key segment to watch. Earnings from Kellogg's, Papa John's, and Shake Shack is going to give us some insight on consumer spending. Also on tap, Anheuser-Busch, its Bud Light brand, taking a major hit following that backlash from its advertising campaign with influencer Dylan Mulvaney. Meanwhile, after the bell, all eyes are going to be on Big Tech. Apple is set to report its results. The stock has soared about 50% since the start of the year. The tech giant also recently crossing that $3 trillion market cap heading into its earnings report. Also, we have Amazon. The company's 2023 Prime Day in July saw sales in its first day hit a record. Investors are going to be looking beyond e-commerce at the growth and the outlook of its cloud business. You know, AWS so important there for Amazon. Meanwhile, in the legal arena, Donald Trump is expected to appear in a Washington federal court. The former president facing federal charges related to the 2020 presidential election. This makes the third criminal case against Trump as he seeks a new term here, runs for president in the 2024 presidential race. That does it for us today on Yahoo Finance Live. We'll see you back here again tomorrow, 3 p.m. Eastern Time. Have a good night.